Let's dive in and explore the two fundamental approaches to investing in the stock market. When you start investing, you'll hear about dividend stocks and growth stocks, two core strategies for building wealth. Each offers a unique path, and understanding the difference is key to making smart choices with your money. Dividend stocks pay you cash, usually every few months, as a reward for owning a piece of the company. These payments can provide a steady stream of income, which is especially appealing for those who want regular returns or are planning for retirement. Growth stocks, on the other hand, reinvest profits to expand, aiming to make your shares more valuable over time. Instead of paying out cash, these companies focus on innovation, new products, and capturing bigger market share. Imagine two pizza shops. One pays you a slice of profits regularly, like dividends, while the other reinvests everything to grow bigger, hoping your share will be worth much more later. Both have their advantages, depending on your needs and time horizon. The choice is between steady income now or bigger potential gains later. Some investors prefer the reliability of dividends, while others are excited by the possibility of higher growth. Every investor faces this decision at some point, and there's no one-size-fits-all answer. Some stick to one type, others mix both, creating a balanced portfolio that can weather different market conditions. The key is to know what you're buying and why. Take time to research companies, understand their business models, and see how they fit into your overall plan. Don't just follow hype. Have a plan that matches your personal goals and financial situation. Your money deserves a strategy, and it starts with understanding these two paths. The more you know, the more confident you'll be in your decisions. Pick what fits your goals and risk tolerance. Remember, your comfort with risk and your timeline matter just as much as the stocks you choose. That's the foundation of smart investing, making informed choices that work for you both now and in the future. Dividend stocks are the reliable giants of the investing world. Think of household names like Coca-Cola or Johnson & Johnson. These are companies that have stood the test of time, weathering economic storms and market cycles, all while continuing to reward their shareholders. They pay you a portion of their profits, often every quarter, as a thank you for investing and believing in their business. It's like getting a paycheck just for owning a piece of the company. For example, if you own a $100 stock with a 3% dividend yield, you'll receive $3 a year per share. It might not sound like much at first, but over time, those payments add up. Reinvesting those dividends lets you buy more shares, which means your future dividends grow too. This compounding effect can significantly boost your returns over the years, turning small payments into a much larger nest egg. The main perk? Predictable income, even when the stock market takes a dip or gets volatile. That steady stream of cash can be a real comfort. That's why retirees and income-focused investors love dividend stocks. They provide a sense of security and help cover living expenses without having to sell investments. You get steady cash flow month after month without needing to sell your shares or worry about timing the market. But there's a trade-off. These companies usually grow slower, so your stock price may not skyrocket like a tech startup. You're trading some growth for stability. You're choosing stability and reliability over chasing big, risky gains. For many, that's a worthwhile exchange. And remember, dividends aren't guaranteed. Companies can cut or suspend them if times get tough, so it's important to stay informed and diversify. Still, for many investors, the peace of mind and steady income are worth it, especially when planning for retirement or long-term goals. It's a conservative, proven way to build wealth slowly and steadily, letting your money work for you over time. Just know the risks, set your expectations, and enjoy the journey of growing your wealth the slow and steady way. Growth stocks are the thrill seekers. Think early Tesla or Amazon. They reinvest every dollar to expand fast, betting on future breakthroughs. No dividends here. Your profit comes from the stock price rising. Buy at $50, hope it's $500 in a decade. The upside? Massive potential returns. Life-changing if you pick a winner. But the risks are real. Many growth companies fail, and prices can swing wildly. You need patience and a strong stomach for volatility. Younger investors often favor growth stocks. They have time to recover from setbacks. It's a high-risk, high-reward game. Not for everyone, but the payoff can be huge if you choose wisely. Just be ready for the ride. Let's compare the two main types of stocks you'll encounter as an investor: dividend stocks and growth stocks. Each comes with its own set of risks and rewards, and understanding the difference is key to making smart choices for your wallet. Dividend stocks are generally safer. These are shares in mature, established companies that have a long history of steady payouts. They're less likely to go bust, and they provide regular income, which can be especially comforting during market downturns. Growth stocks, on the other hand, are riskier. Their prices can swing wildly, and there's a higher chance of losing money if the company doesn't perform as expected. The ride can be stressful, but the potential rewards are much greater. But growth stocks offer the shot at huge returns, sometimes doubling, tripling, or even more in value over time. If you're willing to take on more risk, the payoff can be significant. Dividend stocks, meanwhile, give you slow, steady gains and a reliable stream of income. They're like the tortoise in the classic fable, slow and steady, but dependable. That's why older investors, or those nearing retirement, often prefer dividends. The stability and regular cash flow help cover living expenses and reduce anxiety about market swings. Younger investors, with decades ahead of them, can afford to chase growth. They have time to recover from losses and benefit from compounding returns over the long haul. Most smart investors use both: stable dividend stocks for a solid foundation and growth stocks for the chance at bigger upside. This combination helps balance your portfolio. This balance lets you capture gains while managing risk, so you're not putting all your eggs in one basket. The right mix depends on your age, your financial goals, and how much risk you're comfortable taking. Don't go all in on one side. Diversify across different types of stocks and sectors to protect yourself. That's how you build a resilient portfolio that can weather market storms and keep you on track. Remember, your investment strategy should fit your life, your needs, and your dreams for the future. New to investing? Start by knowing yourself and your timeline. If big drops stress you out, stick with dividend stocks or a broad index fund to start. If you can handle risk and have decades ahead, add some growth stocks for bigger potential. Diversify. Don't bet everything on one company or style. A simple way to begin: buy a low-cost S&P 500 index fund for instant diversification. As you learn, adjust your mix to match your goals. The most important step is to start. Don't let fear hold you back. Educate yourself, stay consistent, and let time work for you. Your future self will thank you. Keep learning and watch your wealth grow.